Hello and welcome back to Southbank Live episode 24. We are now close to the Christmas period. We're almost close to winding down the office for the year. However, we still have a couple more of these in the bag. My name is Boaz and I'm joined as ever by John Butler. John, how are you getting on this week?
Oh, very, very well. Good evening.
Good evening indeed, and good evening to everybody who is tuning into this episode. It is great to be doing this live still, rather than just doing all the pre-recorded stuff. It's great to engage with our audience a lot more. The whole point of the show, if you're new, if this is your first Southbank Live, is to discuss some of the market events and themes that have taken place and become quite relevant over the past week. So, if you have any comments, if you have any questions you'd like us to pose, ask, discuss, then please feel free to put them in the chat, provided, of course, that they are investment related. Now, this week we have quite a few things to go over. It's been a very interesting week for markets as we do get close to the Christmas period. There is the phenomenon known as the Santa rally, and we're going to discuss whether or not that's going to occur. As, of course, we are getting close to Christmas time, we thought we'd have a bit of fun with a competition, with a giveaway. We'll be giving away a custom 1 ounce round of silver later on. We'll do that after we've discussed some of the main themes. But yeah, first off, John, in terms of what you've been seeing this week in the markets and in the news in general, what would you say are your major takeaways?
Well, it's interesting to see that this week several things happened, and they happened almost simultaneously, and they happened following on some of the discussions we'd had about these possibilities. That is, central bankers are getting hawkish now. The Bank of England has actually raised rates. The Fed is now making very clear they're planning to raise rates at a faster pace than they previously did. And even the ECB has now suggested that some of the pandemic-related policy that they have been implementing is now finally reaching its sell-by date. They're going to start winding that down early next year. So you've got three major central banks all either sending pretty clear hawkish messages, or actually pulling the trigger finally in the case of the Bank of England. And of course, why shouldn't they? We've been talking about inflation continuing to rise. And indeed, the most recent prints have it reaching yet new generational highs. These are big numbers that fundamentally impact the psychology of consumers, households, businesses, you name it, markets. And so a lot of stuff that we've been talking about is now actually happening. But as we also discussed, the possibility of the Santa rally, this being the time of year it is, and the fact that central banks are demonstrably behind this inflation curve, such that real interest rates are, they're as low as they've been, right? The fact is that markets are shrugging it off. And I'm not remotely surprised by that. So it seems an odd mix that markets can just shrug off, and yet they are indeed shrugging it off. It's just not the full set of conditions, and it's just not the time of year for it to lead to a major reversal. That said, there are some subtleties, though, when you look at sector rotation and when you look at the breadth of this modest rally that we've seen in stocks this week, notwithstanding central bank action. And that holds some interesting clues for the future.
Yes, certainly. The Santa rally phenomenon. I don't actually know how long that goes back through history, how frequently that has occurred over time, John. Just this, it's a dynamic that is very much an American one, but of course the American stock market is so big that even if you're on the UK, you can't really afford to ignore the American stock market. And the Santa rally is effectively dictates that as we reach the very end of the year, generally in the later days of December, we do see a big rally in the stock market, which often continues on into January in the new year. So it does feel like the stock market is getting rather festive, John, despite all the inflation data. As you say, the breadth in the rally, it's mostly just the big tech mega stocks who are really going for it. Do you think tech and inflation shouldn't mix together that well, I would have thought. Do you think there's any chance that inflation is really going to stop this, but it's going to happen well into next year?
Look, the way tech has been behaving, and this is not just a recent phenomenon, it's been going on for the most part for years. Tech, this is going to come across the wrong way perhaps, but tech the sector behaves increasingly almost like a cult. It seems that every time it begins to correct its valuation a bit vis-a-vis the broader market, there is some new story about some new potential this, new potential that. And indeed, think about the pandemic itself. When it hits, of course, the stock market gets whacked everywhere. And that also hits tech. And then people are sort of saying, well, wait a minute. If there's one sector that should hold up, just notwithstanding the pandemic, it's tech, because if you're locked down, you can still do all your online commerce and whatever other online advertising and online whatever it is that keeps that sector going in terms of its outlook for revenues and profits. And so it's almost as if they're always pulling a new rabbit out of their hat. And again, beyond a certain point, I'm not sure that will hold up to reality. But hey, it has. But again, you look at the broader market and you look at both the breadth and the sector rotation. If you take out the 5 largest tech stocks from the US market, the broader market has actually not really risen this year now. I mean, it doesn't look impressive. And within that broader market, the sector rotation looks actually a bit defensive now. That is, the sectors that are holding up somewhat better are ones that tend to have less downside in difficult conditions when you do get market corrections. So it's looking very stretched now along these sorts of metrics. But again, the timing for the year may just be wrong for some sort of gravity to set in. So I still think the tech is a major correction waiting to happen. But as I've said before, the timing probably just isn't right.
Yeah, it's funny with it where the big 5, it reminds me of in Africa where you've got the big 5, the big 5 species of animals. You got your lions and your rhinos and whatnot, and these are the pride of Africa, etc. And here we got the US stock market where it's just these tech titans. They're not conglomerates. I mean, they're just these. They're a conglomeration of internet related things and tech related things, but it's not like
they are big when it comes to tech. They are big IP conglomerates, and if you look at what Amazon's done with its movement into servers and into all kinds of web services and whatnot, they have gone way beyond just rank and file retail distribution. Right. So I mean, you're right. The world in a traditional sense that a conglomerate would be involved in many physical industries and maybe even having a financing arm and these sorts of things. It looks different, but it's beginning to share similar characteristics.
Yes, I mean the sheer scale of all the different things Amazon does is so large that you may as well call it a conglomerate. I mean, when you're talking about,
we're getting there.
They're delivering. They start with, of course, delivering books, everyone knows, but that's not actually where they make the real margins, the real revenues. That's from Amazon Web Services, their big branch, or AWS as it's just called, and it's so big that AWS by itself sponsors loads of sporting events. So it's not Amazon, it's AWS, and then they're bidding on all these massive defense contracts because of course the Pentagon needs all of this, all these server farms and security and whatnot. It is such a big collection. It may as well be a conglomerate. But just taking a look at the chat. Good evening to everybody who has joined us. To May and Alexander who say hello. Good evening to you both. It's good to have you both here. Liam has a question relating to what we discussed last week. John. Liam says, evening, John and Boaz. Last week, John was talking about spending cash. Should you just buy loads of land like Bill Gates? Agricultural land rose 30% in value last year in America due to COVID. What do you make of that, John? I mean, agricultural land seems like, if you're a real purist and you really like your real assets, inflation-proof assets, agricultural land seems like a very attractive option. But of course, it comes with all manner of extra costs, right?
Oh, absolutely. And it's not, I mean, not just anyone can snap up agricultural land. I mean, there are some funds, I believe, that do try to provide exposure to that. But as a general rule, the way to do it through the stock market, which is the way that's most easily accessible to most people, is you just buy your big agricultural conglomerates because, of course, they do own a lot of their land. Yep. But they tend to own a lot of the value chain as well. So you're getting some land in there, and then you're getting a lot of the other refining, processing, distribution, so on and so forth. And there are several very large agribusiness firms that do all of the above that are a way to play that story. And it is a good story. Look, the fact is, again, timing. It's such a difficult thing to do, obviously. But when you step back from a history of periods of rapidly rising inflation, those firms that tend to do best are the ones that have the pricing power. The ones that have the pricing power tend, not always, but tend to be linked fairly directly to real assets. That is, things that are strictly limited in supply, but for which there tends to be at least always some residual demand. Basic industries, mining, forestry, agriculture, fishing, these so-called foundational industries without which modern civilization is basically impossible.
Quite.
Okay. And you can throw in some stuff that is actually quite innovative and modern in there. You can throw in chemicals and metallurgy and things like this, but they're all, notice what they're doing. They're all working with real things. They're not just pushing paper around. They're not just trying to sort information more efficiently. I have nothing against the information economy, but the PE ratio currently on the information economy is through the chart. Whereas the PE ratio right now on these basic foundational industries is kind of neither here nor there. So if you're concerned that this inflationary environment we're getting into is going to cause just general economic trouble, going forward, in my opinion, stagflationary economic trouble, this is the sort of sector rotation that you want to get into.
It is an interesting proposition, but as you say, it's one of the sectors which isn't, massively decentralized. You got all these very big players, as you say, the ones who have the pricing power, and they are the ones who are able to, not only just realize, all the value of the land when you own loads of it and you have the full value chain integrated into your operations, but they also have, lots of connections, and they've got the bidding power for getting the right patches of land that they want to expand into, and so on and so forth. But it does seem like, in a world of rising inflation and where you've got these supply chain disconnects, provided the supply chain disconnects don't destroy your crops, then it would be a very, very attractive, proposition.
Well, I mean, recall that my big long recommendation from, I forget whether it was 2 weeks ago or 3 weeks ago, I think 3 weeks ago now, was to look specifically at logistics firms, because the fact is that logistics, even though they themselves don't really own underlying real assets, as you say, they're essential for getting these things from point A to point B, and doing so in a way which is efficient enough and is suitable enough to make sure that perishables still make it, and whatever it is, whatever further intermediate good processing needs to take place can occur efficiently across the world, and so on and so forth, to keep supply chains moving. I think these firms are absolutely golden, not only because of the difficulties that we've already discussed, but just the fact that now that people see just how potentially disruptive a just-in-time inventory process, how disruptive that can be when you're affected by some exogenous event, be it a pandemic or anything else, everyone's going to demand Plan B. They're going to want another provider. They're going to want more capacity just in case things don't go according to plan going forward. And that, to me, is going to be a big bull market, at least in relative terms.
Certainly. Now, Elizabeth comments in the chat. She's read somewhere recently, there's been a Santa rally 21 of the last 22 years. Well, thank you for that fact, Elizabeth.
Wow.
It seems like Santa's been showing up for the majority of my life so far. I wonder if he'll carry on for the rest of it. I think I do wonder how much momentum the Santa rally has, because everyone expects it to happen, so everyone trades as though it's going to happen, and whether or not that is like a placebo. And
you'd want to filter your data set also, right? Because if the Santa rally is simply an extrapolation of what was already an established bull market, as you say, a momentum factor, it would be more interesting to see in how many of those years do you get a Santa rally, notwithstanding a lackluster or even down market in a given year. That would really, be the eye opener. That is, if you still get your Santa rally, even when the year's been kind of, not so great, then that's a really bullish sign. Regardless, though, 21 out of 22 is a big ratio. And again, it's the no-brainer thing to do, right? Just let it ride.
Quite. Now, Elizabeth also asked, do you think Tesla might blow up next year? Now, if memory serves, a few episodes of Southbank Live ago, John did say that there was a company which could lose 90% of its value and would still be expensive, and it's that it started with a T, but he refused to elaborate further. So maybe next year. I'm not sure, Elizabeth. John, would you like to comment?
Look, the reason I made that comment is you have to understand in what way I'm defining expensive. I'm
Yeah,
defining
yeah.
expensive as the way in which a normally trained equity analyst, given a normal toolkit of data, ratios, valuations, if you were just to cross out the name of what company it was and say, here's your balance sheet, here's your income statement, here's your margins, blah blah blah, please value this company, unless you look at the intangible assets and unless you look at the growth hopium for the future, that's what comes out. I mean, it's not me having some irrational go because I don't like the way the cars look, or I don't like the image the company has, or something like that. It's just saying to hell with all the hype, and let's
Yeah.
just look underneath it. So then you have to ask the question, well, gee, John, maybe the hype is worth something, and that's where I admit I don't know, because maybe it is. But if you're going to value them as a traditional industry company, it's a traditional industrial company, that's what comes out. And don't get me wrong, again, there may be something to it, but you can't tell me that Tesla, in terms of what it offers as an entirely new paradigm, is as qualitatively different to the existing automobile industry as what Amazon was able to offer by completely redefining retail as an industry.
Hmm.
I think what Amazon did is fundamentally way bigger than what Tesla is doing, which is taking a car industry and just putting a battery in instead of an internal combustion engine. Don't get me wrong; they're doing more than that. I'm simplifying, okay? But to me, the two are not. Our two are not compatible. And so for people to be valuing Tesla as if it's the Amazon for transportation, I don't buy that story. Maybe I'm wrong, but I don't buy that story as it stands now.
I share your sentiment there with Amazon having having a much more disruptive force and totally reshaping retail ultimately. But perhaps it's that this Tesla story is easier to understand. So it's more memorable in that, oh well, it's just they're cars, but they're electric cars. And they're really futuristic. I think when it comes to with Amazon and where we're talking about, Amazon Web Services and how much people know of where Amazon actually makes all of its money, and what the scale of their operations are, how they're all set up. I don't think people get that. And Amazon doesn't make a big deal out of telling people that either. That's not part of their. That's not how they advertise. Not how they
When
market.
it comes to basic, and you can try to apply a modern framework to this, but when it comes to basic so-called KPIs, key performance indicators,
Yep.
look at things like customer acquisition. Look at things like estimates of lifetime customer value. Look at these sorts of things. And if you apply them to Amazon and the full breadth of what Amazon is now providing, and you compare that to the global automobile market, which in terms of its total value added to global GDP it's such a small sliver anymore. And are we really going to see auto fleets in the world rise by 10, 20, 30 times? Or are we just going to see the existing automobiles transform? Again, replacing an internal combustion engine with a battery. Fine. Yes, there's value to be added there. Absolutely. But how Tesla can be valued more than the rest of the whole automobile industry combined when putting a battery into a car is something that BMW can do, Mercedes can do, Jaguar can do, I mean Volkswagen can do. It goes on and on and on, and they're beginning to do it in earnest and much better. I think that is a much more dangerous position than Amazon, which has these KPIs. They're already established. It's already there. The numbers are already there, in a way that Tesla just has not yet achieved, in my opinion, in a much smaller industry than general retail.
Yeah, yeah. Funnily enough, John, I actually had my first ever ride in a Tesla last week.
First
Yeah,
ever.
first ever. I'd not been
Okay.
inside one of these things before, and I wasn't intended to either. I just I booked an Uber, and I went for comfort because I'm really tall, and so when you're in small cars, it's very uncomfortable. And a Tesla Model S showed up, and yeah, and I'd never been inside one of them before, and I can understand why people think it is quite. This is what the future looks like,
Oh,
and the
it's
driver.
cool.
Yeah,
It's
the
it's
driver
it's
did show
cool.
off the acceleration, incredible torque. Feels like you're in a roller coaster.
Absolutely. Teslas are sexy. Teslas are cool.
Yeah, yeah.
Teslas are trendy. They tick all of these boxes, and indeed, it. I mean, I happen to know someone who owns one of the first 10 serial number Teslas
Oh
to
wow.
roll off the original assembly line.
Does it still work?
It does actually, although he's upgraded to another one, but he does have this original. It's now a collector's item. He's keeping
Yeah.
it. Um, but it helps that this this guy was quite big in Hollywood and had the connections to get into the queue. But it just kind of goes to show just how trendy and how much this is part of this image and whatnot, that Hollywood is literally plugged in to the whole thing. And it's cool to be a Hollywood star and drive around in a Tesla. And again, more power to him. I mean, the fact that he managed to tap into the zeitgeist to get all this momentum, great. I mean, this is what entrepreneurs can and should do, but it's just gone so far now, and the numbers just don't work for me anymore.
Yes, indeed. Elizabeth's question was, do you think Tesla might blow up next year? I do note that this week, Elon Musk has made it to the front cover of which magazine is it? I don't think it's Time
Time,
magazine. Was
time.
it Time magazine?
Yes,
Right, right. I
yes, he
wish
made the cover of Time, Man of the
it
Year.
it would be a very fitting top signal if that's when it all starts going down. But we'll have to wait and see. Now, moving on slightly here, I thought we could dwell a bit on the fact that Bank of England has raised interest rates. Stephen in the chat comments, this is all theatre. A rise of a fraction of a percent is meaningless when inflation is rising by several percent a year. And I would definitely agree with Stephen there. One wonders, when Einstein was saying that compound interest is the eighth wonder of the world, or I can't remember which one. I think it was the eighth wonder of the world. He who understands it earns it, and he who doesn't understand it pays it. One wonders if he was thinking of compound interest of 0.25% per year, because while it will compound, I'm not sure. It's hard to build an awful lot of savings with interest rates
Well,
like
look,
that when inflation is so high.
in real terms, it's compounding negatively.
Yeah,
And so
we're all
graphically,
paying
right,
it.
positive compounding goes like this, right? And negative compounding goes like this. Which and the fact is, as long as real rates are negative, this is what you got from your savings. And again, this is what, if it remains the case for a long period of time, periods of negative real interest rates eventually result in capital consumption, because you don't even save enough as a society to maintain the existing capital stock in its efficient form. Stuff starts to decay. Roads and bridges start to fall
Yeah,
apart. Rail lines start to not work efficiently. You have maybe a health system which is no longer keeping people very healthy, so they're less productive at work. These sorts of subtle things are much more associated with periods of negative real interest rates than positive real interest rates.
yeah, certainly. I think. Yeah, 0.25%. Maybe this is the beginning. Maybe Andrew Bailey over at the Bank of England is just going to start really aggressively ramping it up, bringing back 5, 6, 7%, John. But I'm not too hopeful so far.
No.
David, Michael, and David, Shaheen, and Ken, sorry, all say hello there in the chat. Good evening to you all. Great to have you here. Michael says now might be a great time to invest in cryptos. Well, maybe it might, and given the Santa rally dynamic, as is mostly in the tech sector, as a lot of the crypto space does have trade with certain beta, a bit of leverage towards the tech sector. Maybe we'll see a fair bit of that over the Christmas period indeed. I would think on the inflation side, actually, and John John Tooth in the chat says, with so much inflation on our doorsteps, gold has risen, yes, but do you think it's lagging? And this brings us quite neatly through to sort of our middle point here, where we're discussing a bit about precious metals and indeed our little silver giveaway, John. Because before we came on air, we were just having a little chat about precious metals, actually, and it is very interesting for me to see that despite all these raging inflation statistics, we don't see a huge amount of fervor in gold yet, or indeed in silver. But the classic saying that gold and silver never do what you want them to do when you want them to do it, maybe is the reason why. Could you explain a bit what your take is on gold and silver at the minute?
Well, keep in mind these are zero yielding assets, and so you can't sit on them and earn an income. And so people really only pile in when they think that they're going to get a big move, at least if they're doing so for any sort of speculative reason on any sort of short time horizon at all. And so you end up with a market that just trades fundamentally differently than one that's throwing off an income. If you look back at periods of bull markets in gold and silver, they do tend to be short and fast. They don't tend to be long and steady. Long and steady bull markets tend to be characterized by, that is, they tend to be more associated with financial assets, things that are throwing off some sort of regular income. Because that means there's kind of this natural buyer. There's this natural buyer coming into the market. Pension funds have to hold the stuff. Insurance companies have to hold the stuff. And gold and silver are always seen as something which is maybe a sensible diversifier, which of course, I think that, but also somewhat speculative. So when the rallies happen, they do happen short and they happen fast. And if you look back to the 1970s into the early 80s, that's precisely how it looked. You'd have a few months of huge gains, and then they would give back a little bit, and or nothing would happen for a prolonged period of time, and then another few months of huge gains. And what that means is they have optionality. They have embedded optionality to the upside in an inflationary environment, but you don't know when that optionality is going to play out. You just don't. And long-term correlations between inflation and precious metals are very, very high. Short-term, they're practically non-existent. And so you really do need to just see it as sitting on kind of an option that's going to go in the money every once in a while, as long as the macro conditions are favorable. And they are. In principle, they're very favorable.
I think next year, is when we're really going to see precious metals get their mojo back to some degree, because now that the inflation is just transitory, you don't need to worry about it. Everything's going to go back to normal. I feel like that's thoroughly been put to bed at this point. And next year, it'll really start. People really start to realize that prices are going up, and they'll continue to go up. But though, of course, I could be wrong. Maybe
we've come a long way already, right? I mean, inflation is again higher than in the lifetime of many people today, and that's why I say it's at generational levels, right? You have to go back a full generation to see these sorts of numbers. And keep in mind, if we take the wholesale and producer price data as a leading indicator, which is reasonable, and I think you should, we are not done yet. It's another few percentage points are baked in the cake here, and there's something about human psychology when you get into double digits. How many fingers do we have, right? When you get into double digits, it sort of triggers this part of the mind. Holy, what? And so I think that if we do end up in double digit territory, it's going to be yet another psychological blow to those who somehow thought, oh, gee, inflation's transitory. Oh, it's not something I really need to worry about. Oh, I don't need to restructure my portfolio. Oh, I don't need to ask for a pay rise. Whatever it is, I think at that point we're going to get into just another big round of disruption for corporate profit margins, which is where this all will come home to cause trouble, because that's where the real squeeze is going to happen.
Yeah, I wonder, John, how. Because, as you say, once it gets to that, the 2 digits, right? The figure is now 2 digits. Everything seems to change to some degree. Just like, it's just like when people are selling things, they'll often do it at 99p instead of £1, or 199 instead of £200. The government, I think, well, people who are obviously wanting their inflation statistic to look low, so it doesn't look like they're mismanaging the economy, will want inflation figures to remain below 2 digits. So it could be 9.5 instead of 10% or 10.5%. And I wonder whether or not we're going to see a lot of messing around with the basket, the CPI
Yes.
inflation basket, in order to keep that going. Because if memory serves, I think when Goldman Sachs was helping Greece get into the eurozone, they needed to prove that their inflation was not excessively high. And one of the methods that they did this was by constantly changing their inflation basket in a ways where it was the fruit. So they would take it one, but the guy that was compiling this inflation basket and checking the prices would one month he would include the oranges, and then other days he'd include lemons instead. It was all depending on what the price of this fruit was, because they wanted to keep inflation low, or they wanted it to appear low, so that they could then qualify for membership in the eurozone. And I feel like maybe this old art of goosing figures and lots of playing around with numbers. I think we're going to see a lot more of that, because while inflation could get to double digits, I don't think we'll know it's double digits for quite a while, because they'll try and keep it down. But that's just me. That's me being a
Look,
little
look, what you say about inflation. Look, inflation statistics are human constructs, and they are subject to human error, and indeed, you could say human bias, if there is some sort of agenda in play,
Yep.
and one can see why there might be. And what I think is interesting is that we've seen major inflation indices revised periodically in major developed economies for decade after decade after decade. One thing that strikes me as curious is the following. In each and every instance, the way in which they revise the methodology always results in a lower rate of inflation than the prior methodology, because they usually tend to continue producing the prior methodology data set, time series, for a while, because they need it to reference certain legacy things that are linked to that. And so what you have each and every time it ratchets lower, it never ratchets higher. Is that a coincidence? I don't think it is. And so, look, inflation indices are estimates, and they are subject to estimation, and they are subject to outright abuse. And I think there is evidence that that's the case. Recall, oh gosh, I forget when it was now, 10, 15 years ago, the United States and some other countries were giving Argentina grief for claiming that its inflation number was still in the single digits, when it was blatantly obvious to everybody that it was perhaps as much as twice that. And they were giving Argentina a hard time. One wonders at what point, the pot isn't calling the kettle black on some of this stuff.
Yeah. It does feel like some of the tactics from the less developed areas of the world will probably become a lot more, or maybe they're already here. It's just that done in such a subtle manner that we don't quite realize it yet. Plenty of people believe that the basket is manipulated, and there was a big change, of course, from RPI to CPI, which didn't involve property prices. Now, just in terms of on the precious metal side, of course, I think we could get on to our little giveaway, which in the spirit of Christmas and everything, I thought it would be a nice thing to do. This is actually let's see, here we are. Here is our. I wonder if the camera can pick it up quite well enough. This is one of the silver rounds. So coin, you can only call it a silver coin officially if you're crazy into bullion. If it's actually minted by a government and given a face value, this is a silver round. So it's 1 troy ounce of silver. We had 200 roughly of these made a little while ago, and we had it cut with a custom design on the front as well. So 200 of them, they were all limited. It was a limited batch of these that we had. We had them numbered individually, and they were assayed at the Edinburgh Assay Office, which if you spend a lot of time in Edinburgh, is just around the corner from George Street. It's not in the most it's not in the kind of building you would expect an assay office to be in. But these were melted down, and I believe it is 4 nines pure, so 99.99% pure, and it has ad lunum inscribed above the top with the image of a wolf. I wonder if this can. I'm probably not the best. You can probably see a little bit of this if it focuses just right. And we still have a few of these left, and we thought we'd give one of them away. So the reason why ad lunam is inscribed on there is Latin for to the moon, which is actually a crypto saying you see a lot of people using, but it's something that we thought sums up somewhat a bit more of our bullish sentiment about silver, with silver always being thought of as the lunar metal, while gold is the solar metal. John, in fact, you were telling me the other day with is it Artemis and Apollo being the sun and the moon, and the sun and moon metals? Could you expand on that a bit?
Well, yeah, I mean that was an aspect of Greek mythology. So they're twins. One is a boy, one's a girl, but they're twins, and they are son and daughter of Zeus. And one is associated with silver and the moon, and one's associated with gold and the sun. And the Greek in Greek mythology is not the only religious tradition which has these sorts of clear distinctions. And it is worth pointing out that the Egyptians, the Chinese, anywhere you go, these distinctions were made, and yet when it came to the actual circulating coinage, silver generally won out. Gold was, don't get me wrong, gold was also used as coinage, but it was used predominantly in religious ceremonial uses, and ones that also conferred authority, that is the property of kings, princes, royal families, and so on and so forth. It wasn't used as much for circulating coinage, whereas silver was used hugely in circulating coinage, and also things like tableware. Silver tableware,
Yes.
which was a very common thing for not just kings and princes to have, but any household of means would likely have maybe a small handful of silver implements. So silver circulated much more amongst the general population than gold did. So gold may have been kind of a de facto monetary base in a primitive sense. But silver was kind of stacked on top of that, and was actually what traded, what actually changed hands for actual goods and services the vast majority of the time.
Yeah, silver has been. Yeah, people forget about it, but silver has been money for longer than gold has, and yet we don't really think of it quite in the same way today. Though here in English, of course, well, when we're speaking English, the word for sterling being silver, and of course in so many other languages, the same word for money is the same word for silver rather than for gold. And indeed, as inflation rages and paper currency loses its value, we do think that, well, personally, myself and indeed John believes that silver will have its time in the sun, or its time in the moon once again. So, as I say, we are giving this away. It's a little competition. It's quite simple. You just need to answer this question. So it's taking a little bit of history here, though. If you aren't familiar with the history, it wouldn't take you too long, I don't think, to figure out what the answer to this question is. If I can bring up the image here, just to make this give it slightly more illustration. So to get a chance of winning this silver round, all you need to do is answer this question. You can post your answer in either the live chat, or you can do it in the YouTube comments if you are watching a recording of this, or indeed you can send it over to our Twitter or to our Facebook feed. It's just Southbank Investment Research. You'll find it both there. And the question is, what asset connects the lives of Julius Caesar, King Richard I of England, King David II of Scotland, and importantly, how? So that's what asset connects the lives of Julius Caesar, King Richard I of England, King David II of Scotland, and how? So if you can get your answer, don't worry, you don't need to ping it in the chat now. You can send this in just before our next show, which shall be on the 22nd. It'll be on Wednesday next week. That's when we'll pick the winner. You just need to send in your answer to that question. We'll pick one at random from the correct answers, of course, but you can only answer once. So we have the full terms and conditions in the descriptions of this video. And good luck. It's an interesting story, I think, that does tie these three men together, or connects them together. And yes, that's how you can win that. So we'll announce that next week in our formal Christmas show. And yeah, that's when we shall announce the winner too. So going back to the main thrust of the show, I thought we've got a few interesting comments in the chat here, including recommendations that I go easy on the vodka. Well, sadly, I've not had any vodka this evening. Much more of a rum and whiskey drinker, I'm afraid. But going forward with our topics for the evening, John, in terms of our long and our short, have you got a long and a short for us this week?
Well, I do. Although that said, I'm going to kind of borrow on what I've already said today, which is that although I've mentioned it before, I think the big tech firms in the U.S. are just so overvalued vis-a-vis the broader market. The broader market is sending you a message. The broader market is telling you that all is not well with the broader economy. And history tells you that even though tech was a very different sector in the 1970s, there is, to the extent it was a sector, it did struggle to do well at a time when it didn't have the same degree of pricing power that basic industries and non-discretionary goods have. So I think I'm going to highlight that yet again, because the Santa rally, to the extent we're seeing one this year, is driven by those stocks. And it just leaves them as big outliers vis-a-vis the broader market, which is trading as badly as it's been all year. Not that it's had a bad year, but it's continuing to lose momentum. It doesn't look interesting, and it's not participating in this Santa rally to any meaningful degree. So that to me is an obvious short. And then the long, also, we've already mentioned it. I just think precious metals are being left behind here as real assets. As inflation continues to rise, as central banks may have become a little bit more hawkish, although oddly enough, on the day, metals kind of shrugged it off. There was a little bit of buy the rumor, sell the fact there, which may also be a little bit more evidence that the precious metals are putting in a floor and are due some sort of bounce as we head into next year.
It does feel like something will occur with precious metals. I don't think it's going to be. I don't think it's going to be a crash. But then again, we have been blindsided with so much of the market action this year. Now, I have been reminded in the chat that I should always ask a question 3 times in modern times because of the lack of attention, because of low attention span. So I shall ask our little competition question once again for any of those who missed it. So it is: what asset connects the lives of Julius Caesar, King Richard I of England, King David II of Scotland, and how? Hopefully, that everyone who was listening, who wanted to hear that, has listened to it. But if you do want to, check in with that again, we shall be posting it on our Twitter and on our Facebook as well. Now, looking at my sort of long short for this week, John, I think I'm going to be short. I think I am short Christmas parties. Because just here at Southbank, we do try to do a Christmas party every now and then. But there has been an awful lot of as Bojo announces the Omicron's here, we're going to have to. We're thinking of doing lockdowns. We're thinking of imposing XYZ manner of restrictions. A lot of people are quite understandably concerned that they wouldn't be able to, they'd have to lock down while they're in London and not be able to go home to their families for Christmas, which makes me quite bearish on Christmas parties. So that would be my short for this week. In terms of my long, I think I'll take a leaf out of your book and go long precious metals, because I do feel like it has been a kind of a rough year for precious metals investors, or a rough 2 years almost, because despite the great rally that we did have in 2020, it's certainly waned somewhat. There was a comment in the chat which I thought was quite good. Yeah, from John, who said gold miners were great at the height of the COVID uncertainty, but like a fool, I held on to them. The low real interest rate story, 2 years and still waiting. I want $1,835 an ounce first. Well, I wouldn't say you're foolish for holding on to them, John, depending on what your investment horizon is. But they certainly has been a grim time to own a lot of these companies. But then it's been a grim time to own a lot of things that aren't tech plays over the past couple of years, I would say. John, what's your take on that? Because the sort of the gold tech divergence is something I find very interesting. They have these sort of very divergent dynamics. And our mutual friend and colleague Charlie Morris has done some great some great back testing when you're looking at the performance of gold and tech together, and it does come out, because they're so different from each other. They actually, you get very strong returns with less volatility with gold involved. Well, have you any thoughts on that? Would you ever want to try and take some of these tech plays and mix them in with some precious metals, or as the sector is so expensive, you just want to stay away from it completely?
Oh, look, diversification is the only free lunch, right? And so if you're going to construct a diversified portfolio, well, clearly the nature of a gold miner and the nature of a tech firm are so completely different, notwithstanding the fact that a large number of tech products have some tiny amount of gold in them, or occasionally silver as well. But really, but in terms of what they really are and what they represent and the risks they represent and the promise for growth they represent, very, very different. So if you're simply taking a long-term view and you're trying to build a diversified portfolio, absolutely you should be exposed to both, and then do diversify each other rather well. And I've already mentioned the 1970s, a period when tech really struggled, and yet precious metals miners did terrific. But there have been times in more recent years, as we know, when the opposite has been true. So there you go. You're getting your diversification, but you step back from diversification and think long term. That's what you want. That said, if you're thinking shorter term, then absolutely, the valuation at any given point in time has to matter. And from this current starting point, just the gap that we see in valuations between tech on the one hand and basic industries, including precious metals miners on the other, that valuation gap in terms of your basic valuation ratios is absolutely astronomical. And that to me does not sit well with the macroeconomic background. If the macroeconomic background were different, I might be willing to let it slide, at least for a period of time. But with the current macroeconomic background of entering into what I believe, and this is my view, is going to be a prolonged stagflation, you want to be the other way around on this one. You want to be short the tech now and long the precious metals miners. I've been saying it all year. Obviously, I'm way too early, but that's where I think this is going.
Yeah, I agree with that. I think I think when you're at extremes, or what feels like extremes, you wonder if diversification, but not diversification, but you wonder if following a rally, following a trend is really going to help you out. So even if you're trying to say, oh well, I'm protected because I'm owning this, if the thing that you're invested in is so overvalued that your protection may not actually work, a bit like wearing a bulletproof vest and then getting shot with a cannonball kind of thing. I do have a question from Liam. What is our Twitter address? I believe, Liam, that our Twitter handle is Southbank Invest, at Southbank Invest. If you on Twitter, I'm not sure. I think in Facebook, if you just search for Southbank Investment Research, you shall find us. Robin asks, weren't you long Christmas parties last week? Which is an interesting observation. When in last week's show, I believe I was long house parties. When I'm referring to Christmas parties this week, I'm referring to when you have a group of people at an office who then go out somewhere to have a Christmas party. So almost got me there, Robin, but not quite this time. John says, thanks, Boaz and John. You're very welcome, John. Thanks for tuning in. And Mike says, gold doesn't pay interest, but at least it holds its value in the medium and long term. Sure, I'll put my money in the bank and get a cool 0.5% interest while inflation runs at 10% plus. Indeed, Mike, it's not, seeing bank adverts where the promised rate of return on a savings account is less than 1%. And they've still got all of the great slogans. They've got the nice stock images of happy families and houses and saving for retirement. And they're saying, just check out our great new product that will pay you less than 1%. It does seem rather strange, John. But then I suppose if we went to Japan, where people are used to getting a pay cut every year rather than a pay rise because they're so used to deflation, maybe that's the norm. Do you think there's lessons in Japan for us?
Well, certainly that's a very different sort of regime and a very different mindset. It is worth pointing out that Japan is, look, by any measure which is done in per capita terms, Japan has continued to grow throughout this period when people kind of wrote Japan off of, their economy is dysfunctional, this, that, the other thing. A lot of it really is demographics. And I'm not saying that's not a challenge. Demographics can be a huge challenge for a society, absolutely. But in terms of per capita income growth in real terms in Japan, Japan's done as well as any other large industrialized country over the past 20 or 30 years. And so this idea that Japan is simply doing poorly, it really, you can only explain that because of the demographic issues that they've got. So I actually think Japan has somehow still managed to do certain fundamental things right, mostly right, and in a way which is not generally acknowledged by those who would support ever more expansionary monetary and fiscal policy in the Western developed world, for example. So, is there a lesson in Japan? Well, the lesson is is that the more extreme example, of course, is what happened in that Western developed world when it was the Western developing world in the Industrial Revolution, and when the money supply was essentially fixed because that world was on a gold standard, and it was perfectly normal for a working man's or woman's wages to be stagnant, literally stagnant, year after year after year after year, rather than ever rising. And yet, that was okay because the price level was actually falling. And so their standard of living was gently improving.
Yeah.
And that's a very different mindset. When you expect that prices will generally decline year after year after year, you're not bothered if you just receive stable wages. But that's the way in which productivity growth impacted these economies that had essentially stable money supplies. Stable money plus more productivity and growth must result in a declining price level, or the maths don't work.
Right.
That's the way the world was then. It's very different today.
Sadly, it does sound when things were a lot more stable and living standards were slowly but steadily improving, rather than this boom bust that we've got now. It does feel like maybe a better maybe things were arranged in a slightly better way under a gold standard. But of course, we get called crackpots for even suggesting that today, John. So
Well, it's funny. It's funny you say that though, because there were a handful of academic papers that came out in the years following the crisis of 2008 and also the Euro banking crises that we went through. And they said, while it's the conventional wisdom that the world under the gold standard was much more boom bust than the world post gold standard or post Bretton Woods, so you can take the whole
right.
history there. Um, they disputed that the conventional wisdom was right because you finally you finally had a long enough data set post Bretton Woods to do a meaningful long-term historical comparison. Because when the post Bretton Woods history, pushes over 40 years and head towards half a century, you finally have a real historical sample to
Yeah.
compare with the era of the classical gold standard, which was of a comparable length. And so adjusting for the world wars that happened, because obviously that's a bit of an aberration, you compare those data sets and they say, actually, guess what, guys? The conventional wisdom no longer appears to be correct. We've had even more boom bust since we left Bretton Woods. Now, I haven't seen any recent follow-up to those papers, but guess what I think they would conclude if they were updated? That the data set is continuing to drift in this direction.
Yes, though I don't think we'd hear any of the people. Well, I don't think we'd hear many people wanting to comment on that or even wanting to
Not the
change.
mainstream. No,
No,
absolutely not.
no.
Why would the mainstream want to give up their sort of assumed power to use their erudition and wisdom to manage and micromanage our economies to what they think is in they claim our benefit.
Well, yeah, we certainly wouldn't want them to step down from their ivory towers and
Indeed.
maybe change their ways. But
Indeed.
for those who do still believe in the power of precious metals when it comes to keeping economies stable, ultimately, in a non-gold standard, in a fiat standard world, those precious metals still accrue value. They still do their job. It's just not in everybody's benefit. It's just in the benefit of the people who own them. We do have a question from Rune, which I thought was quite interesting. You mentioned Argentina. I did see a news article that said the same about Turkey at the moment, and that the real inflation in Turkey is over 50%. Any comments on that and the consequences? Very good question, Rune. I must say, we're complaining about inflation in this country being higher than it has been for a very long time, but it's not nearly so bad as it is in places like Turkey, well, and indeed still to some degree Argentina. John, on your thoughts on Turkey and the Turkish situation at the moment, it is interesting to see, Erdogan is obviously still in power, and he still controls so many organs of the state that interest rate rises are almost illegal at this point. Or if he doesn't want it to happen, it's not going to happen. In terms of 50% real inflation, it seems pretty brutal. What if you were in such a environment? I mean, what would you invest in other than precious metals?
Well, look, when inflation reaches those sorts of levels, it actually becomes extremely difficult to measure. One reason is by the time you've gathered up the data and analyzed it, the price level might already have moved again on you, and it becomes a real guessing game to try to stay ahead of that. And of course, consumption baskets begin to change in such an environment. Black market activity begins to explode in such an environment as people seek to avoid taxes, to do everything they can to try to keep the final price of goods down. However, there's a simple back of the envelope thing you can do to help get a sense of whether that 50% 50% number is credible or not. The fact is, the vast majority of global trade is still denominated in dollars. Even if it might settle in a different currency, a lot of contracts will still reference dollars in some way. And that's certainly true of the global commodities trade, but a huge number of other goods. And you can take, therefore, the rate of inflation in the US, and don't get me wrong, if you believe that the US is understating true inflation, you need to make that adjustment too. And then you multiply it by the change in the relevant exchange rate, in this case, the Turkish lira exchange rate vis-a-vis the dollar. And if you do that, that should give you the right order of magnitude for what the rate of inflation currently is in Turkey. So if the official number is miles away from that sort of back of the envelope calculation, then yeah, something is almost certainly, definitely wrong.
Yeah.
But as for what that's going to mean now for Turkey, I mean, this is a country that has been through a series of currency crises, which appear not to have dislodged the current government. They always seem to hang on somehow. I don't know what's going to happen, uh, but inflation of these levels, assuming that number is more or less correct, it may be a bit higher. Look, it's hugely socially destabilizing. Hugely destabilizing. Situations like this generally don't last for very long before something's got to give.
Yeah. But then again, I mean, when you look at Argentina and you have so many periods of inflation and defaults, you wonder, and so it seems like this is just something that people get used to. You've got ATMs spitting out dollars instead of pesos over there, just because people are so used to using dollars as their savings. So we complain about dollar inflation, and yet in places like Argentina, people are used to saving in dollars because to them that's just as good as gold, or almost as good as gold, which I find quite interesting. It's also relative when you're in a really high inflationary environment relative to if you're in a relative low inflationary environment, but it's still inflating.
People look for anything, right? People look for anything that is still a tradable good that is not just being devalued, right? And they always find alternatives. The problem is it really gums up the economic works because you're doing something which is just one small narrow step away from barter, and it's just not as efficient. I mean, it's where inflation gets really, really damaging. So people can use alternative currencies. People can try to use precious metals. A lot of that activity has to be black market because, of course, you're not officially allowed to do that. But people kind of find ways to do that. And then, of course, the government says, oh, well, gee, we're going to crack down on it now. And that just diverts more resources towards trying to enforce these ridiculous rules when people are simply trying to get by. And that sort of heavy-handed top-down tax on resources, you got to pay those police, right, to enforce these ridiculous rules. I mean, this is the sort of thing that brings down the Roman Empire, right? So whatever, they're going to have to find some other way out in Turkey. It's not immediately obvious to me what it's going to be.
Yeah, a quick bit of trivia. It does tie in quite well with Argentina being named after silver, argentum being the Latin word for silver on the periodic table. So I believe it's when the first explorers ventured there and met with the natives, they were greeted with platters of silver, which is why Argentina is called Argentina. So a nice coincidence we have to end our show, or maybe not. Maybe there's something that ties in there, as of course South America is very, very rich in precious metals. But John, we are getting on for time somewhat. We do have one last question, which is a question from the chat regarding your scarf. Is it quite chilly where you are at the moment?
It's funny you say that, but it's one of those things of personal preference. I like, especially when I'm working, I like a cold environment. I find I concentrate better.
Right.
And there's something about breathing in cool, fresh air that I like. And so all I need is just the extra layer or two to make sure that my core is warm and I'm comfortable and all that sort of thing, and not outright shivering. I just find it's a better working environment for me, and I think that's true of a lot of people. I think sometimes we don't notice it, that because it's kind of subtle, but just a few additional degrees of heat sometimes makes you a little bit sleepy. And even before you notice you're a little bit sleepy, it might kind of get in the way of your concentration a bit. Look, there have been some studies done on this, and I think they did mathematical puzzles, crossword puzzles, things like this. And they did find a statistically significant correlation that if you moved above a certain range, concentration levels started to trail off a little bit. And of course, if you move below, then you're outright uncomfortable and shivering and your concentration levels fall off. But that range, apparently it's closer to cellar temperature than what we regard as modern room temperature. Anyway, it's a quirk of mine for what it's
No,
worth.
it's interesting. It's interesting, Joe. I think there's definitely got to be something in there. I think I'll use that as sort of the silver lining for I'm going back to Scotland for Christmas and for Hogmanay. It's going to be pretty chilly over there, but maybe I'll be really, really productive at the same time. So you've always got to look on the bright side. Just in terms of closing comments, John, anything you'd like us to end with? As of course, next week's show will be our Christmas show. It'll be the last Southbank Live of the year. But just for this show, anything you'd like to end with?
Not particularly. Just then, I do think it's important, just psychologically at this time of year, notwithstanding how fascinating all this stuff is, or frightening, perhaps in equal measure. It's really good to switch off. And actually, I've kind of entered into a pact with a handful of friends and family this year that beyond a certain date, we're literally going to switch off our phones for 5 days and try
Don't
to
make it to a week,
completely
not a week.
try to completely tune out the world for 5 days. No, we're not going to make a full week. It's not practical given the fact that you got to move around and all this stuff.
Yeah,
But
yeah.
anyway, we're going to try for 5 days.
Well, good
I
luck.
hope maybe other people should give it a go too. Maybe not five
Yeah.
full days, but just a little bit.
Yeah, I think it'd definitely be good for me, but yeah, I need to try and do that as well some point. Though of course, if we did a full, we wouldn't be able to carry on with Southbank Live, which of course is always a good time.
True.
Thank you to all who have tuned in, and yeah, we shall be back next week for our Christmas show, where we shall indeed announce the winner of our little competition. Thanks for all your entries, but we shall of course continue to take in entries over the next. Well, the better half of the next week. So we'll be closing our entries on the Wednesday. That's when we'll pick the winner and we'll announce it in the next Southbank Live. Thank you all for tuning in. It's been great to see the chat so engaged today. And yeah, thanks for all the well wishes. I'm glad a lot of you have enjoyed our chat. So that's all for the moment. We'll be back next week. Until then, have a good one.